Talk markets, overall markets. Stephen Parker, JPMorgan Private Bank, head of specialized strategies. I think you're kind of thinking fair value is about where we are right now. I mean, earnings are about, if you back out special items, we're up, what, 7%?
Yeah, it looks like this quarter is going to get us something like 7 or 8% earnings growth, which is a healthy pace. But yeah, we think that given how much markets have run, we're pretty close to fair value, and rather than looking to own the market broadly, we want to be a little bit more targeted in terms of where we're taking exposures.
Like your range, I think where the S&P right now is kind of in the center, or maybe just at the low point of your midpoint's 59.25. We're almost there.
That's right. For the middle of next year, that's what we're looking at. But I think it's important to recognize just because we're at our target, that doesn't necessarily mean that we're looking to significantly reduce risk in our portfolio. We're happy with the exposure we have, and we're creating our shopping list because we could see some market volatility in the next couple of weeks.
We got the election, so that could. But long term, you don't think elections matter that much?
No, I think I think elections are incredibly difficult to predict this year, more so than any. Mm-hmm. I think policy ends up mattering more than politics, and that's really hard to predict. But at the end of the day, we think it's a mistake to allow elections to force you into making big changes to your long-term portfolio strategy.
Do you think the Fed is on the right track? And what the 10-year's 4.30 today? What's all that telling you?
Well, I think the move higher in rates that we've seen is telling us that markets are worried about potential for kind of a reignition of inflation, depending on what policy could come into play. I think there is some concerns around long-term debt stability, which is causing rates to move higher. But we don't think that this is a worrying trend. We do think the Fed is on the right track. We still think you get a cut this month and one more cut before the end of the year. But I think it's going to be more important to hear the messaging from the Fed about the trajectory into next year rather than one or two cuts.
Well, you've mentioned a few things that are worrisome, like inflation being reignited, and if we're at fair value, and there's all these things, why not take some off the table? Why just stay in just to stay in?
Well, the first thing I would say, Joe, is we've been having a very active dialogue with our clients about doing what you said, taking some profits, rebalancing, not to reduce your overall levels, but because anybody who's been invested in a diversified portfolio of stocks and bonds this year now has a lot more stocks than they did at the beginning of the year because of how much the market has rallied. So I think that discipline around rebalancing, taking a little bit off the table, but we also see alongside some of those inflation risks, some positive risks from a growth perspective. And so making sure that you're not moving too far in terms of the other side of the dial around the risk you're taking in portfolios is where we're comfortable.
You make the point for bonds that in an easing cycle, extending duration at the start is a winning strategy. It hasn't been. It
hasn't been so far. I mean, we're still very early in a cycle, and one of the things that's really important to us is to think long term. I think when we're talking about extending duration, a lot of that has to do with these large piles of cash that a lot of investors are sitting on. They've been very comfortable making 5+% in the current environment. Obviously, we think that cash rate is going to continue to move lower. And if you look back over the last 10, 11, 12 easing cycles, cash has traditionally underperformed core bonds, and by a pretty meaningful amount. So we think even though that hasn't been the trade yet, we're actually watching this move in rates potentially as an opportunity to beginning adding more to bonds, taking another bite out of that apple.
You think with the total debt where it is, that the government won't have any trouble selling into that?
I mean, I think that's a concern that's been making headlines for years, if not decades. I still think that the U.S. is looked to around the world as the port of safety. I don't think that we're going to have issues, particularly not in the near term, around some of those debt fundamentals.
We were never at debt to GDP of over 100 headed to 130. I mean, there's a breaking point.
There is a breaking point at some point, but you've seen Japan has been able to sustain very high debt to GDP levels. Not that that's the model that we're looking at by any stretch of the imagination, but I also think when you look from a demographic perspective, with an aging population around the world, there is a desire and a need for income. And the safety that the U.S. government provides in terms of our fixed income market is, I think, something that is always going to continue to be attractive, even as those debt to GDP levels continue to rise.
I mean, we're safe. We'll see how long there are times when the rating agencies look at what our debt load is, and it raises an eyebrow for what we've done. And we're not going to slow. We're going to slow the spending, are we? Is that ever going to happen?
No, I don't think we do. But I think one of the things, and we just launched our long-term capital markets assumptions paper. We think that shifting from the last cycle, which was all about austerity and a focus on monetary policy, to a focus on spending and fiscal policy, we think that growth is going to be stronger in this next part of the cycle. And as you get government spending, if it's the right type of government spending that can support growth, ultimately that means greater revenues, higher taxes.
Like what?
I think there's going to be a big focus on infrastructure, things like modernization of the electrical grid. These are things that we have neglected for a long time. Clearly, there's been momentum building from a policy perspective to spend more money in these areas. We think that's going to be a key theme, not just in the U.S., but around the world.
So if you did make a shift in equities, what would you shift to?
So one of the things that we think is really interesting is Japan right now. That's a story about long-term corporate reform. So what we're trying to focus on now is less about the results of the election and who's going to win and what does that mean for policy, but rather over the next 3 to 5 years, what are the markets that have structural tailwinds behind them? In Japan, which for a long time has been a market that has not been focused on shareholder return, that mindset has shifted. Companies are a lot more focused on shareholder-friendly activity, focusing on increasing valuation, shareholder return, buybacks. So we think the story in Japan is a compelling one, particularly as we see, a still strong global growth environment which supports the Japanese market.
But what about the Bank of Japan with that too? Don't they play a large role?
Well, they do, but what we've seen is that market reactions, and we saw this earlier with the yen carry trade unwind. That obviously had a significant move in the short term, but markets quickly corrected. And I think ultimately over the long term, policy there is not going to be the big story. It's going to be a corporate fundamental story.